All right, it is 12 o'clock. I know we got a ton of people already on and we got a bunch more that are still joining us, but in the interest of time, we're going to hop right into it because as promised, we are going to try to cover everything that happened in 2022 and the possible paths we might see in 2023 in 15 minutes. After that point, though, we are going to sit here as long as possible to answer any questions that you might have. So if you have any questions that come up, use that Q&A button that's in, depends on your app, top of the page, bottom of the page, and ask those questions. We've already had 4 or 5 or 6, I forget how many questions come in ahead of time. So again, we'll cover 15 minutes of prepared stuff. Yeah, those of you that need to hop off can hop off, and then we'll sit here as long as possible to answer questions. So to get right into it, looking at 2022, and we put this in our newsletter, it's really important to understand in my lifetime, I was actually born in 1974, there's never been a market as bad as we've seen. And when we look at the returns of stocks and bonds together, so I think that's important to understand. If you look at it, despite the worst combined year for stocks and bonds, all of SEM's models remained within their risk parameters, which to us is a win. We don't like losing money, but when you're a quantitative manager like us, where you're relying on historical data, the fact that we had the worst year in our history, in our lifetimes, and our models still performed within their risk parameters, I think that's a win because we're well positioned, as we're going to talk about, to climb back out of this hole that was created in 2022. Another way to look at it, bonds did not provide the protection that they used to provide. The blue box there highlights the previous bear markets that we've seen this century. And you can see that bonds were a nice buffer for people's portfolios. But in 2022, at one point, stocks and bonds were down the exact same percentage. Bonds, using the aggregate bond index, lost 18% at their worst level of the year. Our bond portfolios never got anywhere close to that level. And I think that's important to understand. And one reason we were able to be ready to climb out of this hole that we're in. Looking at other bear markets, we've included this in our newsletter a couple of times. If you look at the overall losses, most bear markets are 50% or more. The COVID bear market we threw in there, I don't think that's the same type of bear market that we're in, and we're going to talk about that here as we go throughout the presentation. But at its worst, the S&P 500 was down 24%, and I put so far. We'll talk about why I put that here in just a few minutes. About 0.7 years of losses, and historically, you see anywhere from 1.3 to 2.1 years of losses, and we don't know how long it's going to take to recover. We're going to talk a little bit about that here ahead. But looking at where we're at, and it's really important to understand the economic environment is shifting. Here's our leading economic indicator dashboard, and you will see some distinct differences between the top and the bottom. And let's talk about that. Why did we not technically go into a recession? If you look at GDP, I know a few people tried to argue that because we had 2 quarters in a row in 2022 of negative GDP, we were in a recession. But there are some asterisks that economists use. Basically, they're looking at, is the labor market slowing enough? Has spending slowed down enough to call this a recession? And that didn't happen. That's been the only area of strength. Everything else was negative enough to throw GDP negative, but it wasn't a true recession just yet. But if you look at where we ended the year at, just 1% growth for the entire year of 2022. And that's pretty rare. That's something that we've only seen during past recessions when you see growth drop that low for a 1-year basis. So that's something to keep your eye on. Here's another way to look at GDP. The blue line is the 1-year change in GDP, and there's that less than 1% growth. But what I think is more important, and we're going to touch on that when I answer one of the questions, is growth has been declining for a really long time as far as what the average growth rate is for the economy. And we've struggled to hit the average growth rate over the last 20 years. And that's something that we have to keep in mind as we look at what to expect going forward. Now, back to the leading indicators, the good. The labor market and consumer spending have held up really well. And the primary reason is we dumped so much money into the economy that jobs were plentiful. If you wanted a job, you can find a job. And people that didn't need money received a whole lot of money from the government and they spent it. So that's still propping up the economy. These are the 3 indicators that we're going to be watching closely in 2023 on whether or not we can say, yes, we are indeed heading towards a recession. Now, the bad, though, the rest of our dashboard, and I put in pink some of the ones that are looking really bad. Consumer confidence. We're looking at levels that we've only seen a few times over the last 40 years for consumer confidence. That's that chart on the bottom left. Manufacturing, new orders is a leading indicator of the consumer goods that people are purchasing. Any number below 50 indicates a recession, and we are there in terms of manufacturing. So all the goods that people were buying with their stimulus money, the supply chain disconnects, that's all gone. And now we're looking at a recession in manufacturing that could filter through to the rest of the economy. And then finally, building permits. We call this the leading indicator of what's going to happen in housing because it takes a long time to get a permit. As people are optimistic, they will try to get more building permits. Well, we can see that building permits now are below where we saw at the depths of 2020. And we're looking at numbers as far as percentage losses that we've only seen historically during the financial crisis. Now, I'm not saying we're going into a financial crisis. I'm not saying housing is going to crash like that, but the activity we're seeing around housing is not good for the economic outlook. I'll leave it at that. So the main thing, and we're going to talk about this here in a second, Federal Reserve, inflation and interest rates. If you look at this chart here, you have core inflation. You can see month to month actually stopped going down. And that's important when we look at what is the Fed going to do with interest rates. Overall inflation increased, and we just got that number yesterday. That's not good. Economists had expected inflation to run so low this year that the Federal Reserve would not only stop raising interest rates, but they would actually reverse course and start cutting interest rates again. Unfortunately, the inflation data is not showing it. And the reason we're struggling right now is services inflation is accelerating. Now, and we'll talk about this when I answer one of the questions, but services inflation is a real problem for our economy. If you look at the Federal Reserve, this is the spread, the difference between the 10-year and the 2-year. One of the best indicators of a recession that's coming up is when this number goes negative. In other words, 10-year rates are now below what the 2-year interest rates are. And on average, that's about 16 months from the time it inverts before a recession starts. And that would put us right at the end of 2023, sometime around December. Now, if you look at the market, I have a lot of words on this chart. The main thing to understand is the Federal Reserve started 2022 by warning that they're going to have to fight inflation. And then we've had a lot of hope rallies, and we're in the middle of a hope rally right now. Unfortunately, if you go back to that last chart, inflation is being stubbornly strong, which means the Federal Reserve is probably going to, at a minimum, keep raising interest rates 0.25% every couple months. But at worst, they may have to accelerate their rate hikes. I don't see the Fed having to turn around and cut interest rates, which is bad for the economy. Now, I show this chart all the time. We drew a line in the middle of last year to say, it looks like the everything bubble is over. We saw that big run up at the end of 2021. I called it the stupid rally because things that shouldn't have been going up were the best performers. GameStop, Bed Bath & Beyond, AMC, things like that were leading the stock market. And that just made no sense because fundamentally they have all the signs of companies that are going bankrupt. And I will leave that at there. Those excesses have to be removed. We've seen it twice already just since 1990, and we're probably in the middle of that. So that means it's a different environment than most people were used to over the last 15 years. Now, I'm going to just breeze through these charts as a reminder. This is what we were used to having is from 2009 until 2020, we saw the Federal Reserve always jumping in and cutting interest rates and adding stimulus whenever the market stopped. Well, because inflation is such a problem still, the Federal Reserve is unable to save the market like they are in the past. The other thing I think you need to keep in mind is bear markets will include strong rallies. We saw in the financial bubble when that burst, we saw some big rallies and everybody said, oh, the worst is over. It ended up not being over. And we saw the same thing when the tech bubble burst. And again, we don't feel like the bear market is over because the data says that the bear market's not over. Looking at SEM and our models and where we're at, this is really important to understand, and I'm going to spend a little bit of time on this, and I will circle back to it when we answer some of the questions. But across the bottom is the level of risk that you take We call this the bucket system. And basically you divide your money out into buckets based on when you're going to need them, what the objectives are for that money, and how much risk you want to take. Now, this is really critical. Starting all the way off to the right, we have a couple models that are always invested in stocks. That's designed to be your longest term money you want to participate in the stock market, because no matter what I say today, over the long run, I'm very confident the stock market's going to be higher today, higher 20 years from now than it is today. Start cutting that number down to 15 or 10 years from now, I'm not so sure, which is why we look at our other buckets, sliding over to bucket 4, 15 to 25 year money. We need to be able to take some money off the table because we may see a market that is negative from point A to point B 10 years from now. And the reason being is valuations are extremely high right now for stocks, even with the losses that we've seen. But what's key here is even in our growth and our balanced portfolios, first of all, we took money off the table and we were fully bearish in these models March 7th, but by Halloween, October 31st, we jumped back in with half of those allocations. But we have money sitting in lower risk, short-term bonds that are giving us some very nice yields right now. And we're comfortable with that, because the data is still saying this is a bear market rally, nothing more, nothing less. We got to be ready for another leg down for the markets. Most importantly, what we see on the fixed income side, remember, buy and hold bonds lost 18% at their worst levels. Our income models never got close to that. That's your shorter term money, that's your lower risk money, and that's where we're at. And so the question is, where might we go from here? And the data is saying we're probably going to see a continued slowdown in the economic data and inflation staying stubbornly strong, which means this euphoric rally we've seen since October is likely to come back down. Now, if we are wrong, and for whatever reason, the economy is able to just start taking off, these allocations where we have sitting in short-term instruments or cash are designed, and we're getting really, really close to a buy signal, an all clear signal where they jump back in. So by being with SEM, you already have one foot out the door, but that doesn't mean we can't put both feet back in and start participating in the market rally. And that's really important to understand. But again, the data, and that's what's going to drive our decisions. The data says it is far too early to get excited and to say the bear market is over. And that's because going back to those leading economic indicators, everything but labor and consumer spending is pointing towards a recession. And that's important to understand, is you got to invest differently ahead of a recession than you do when it's just a little speed bump in the road. And again, if the data is wrong, we're fine with our models jumping back in because there's no opinions that go into how we allocate our assets. Now, the other thing before we close off the prepared section is, when I'm asked, am I in the right portfolio? I always come back to people and I say, that depends on your financial plan. I cannot give you financial advice without a financial plan. Now, if you're with SEM, which means you probably came to us through a financial advisor, ask your financial advisor, are my investments still in line with my financial plan? If you're coming to us, we have a lot of people who came to us from social media and you don't have a plan, contact us and we can put you in touch with somebody who free of charge can provide you a little bit of a roadmap to help you determine whether or not you're in the right investment portfolio, because that is the foundation of every decision. For most people invested in the stock market, hopefully their financial plan says this is 20+ year money you're not going to need to touch at least in the next 10 years. If you do have money that needs to be touched, it should be managed in a more conservative method, and SEM's models are doing that. But if you're coming outside of SEM, you may not be there. So again, it depends on your financial plan. Finally, this is going to be a tough year. I know everybody thought 2022 was a tough year. I believe 2023 could be even tougher because of this relief rally that we've seen. People have kind of let their guard down. And it feels like if history is a guide and the data is our guide, we're going to see another leg down in stocks, which could be problems for you. So continue to follow semwealth.com. There in the middle of the page, you can see SEM Market Insights. At a minimum, we post a blog every Monday. We also last year started a lot more social media, short form videos, TikTok, Instagram Reels, Facebook Reels. There's some QR codes you can follow us along. There's also links at the top of our page. Finally, if you're curious whether or not you're in the right portfolio, click that risk questionnaire, because that's going to be the thing that generates a portfolio review. Your advisor will get back to you, and we will help answer that question of whether you're in that right portfolio. Now, 15 minutes, that's what happened last year. That's what we think is going to happen this year. Now we're going to shift to the questions.